G'day, Ziggy here, and welcome to episode 4 of my podcast, Plan to Prosper. In today's episode, we're going to be talking about superannuation. It's one of those topics that not many people like, know about, push to the side. But we're going to break some myths, we're going to give you some insights into superannuation, and we're going to tell you some information about superannuation that you wouldn't even know. And hopefully that'll make it more interesting for you. So enjoy this podcast. But as usual, before we begin, we start with a joke. There is a Scottish proverb, maybe I should be doing it in accent, Scottish proverb that says, don't marry for money, you can borrow it cheaper. Was that the Scottish accent? I think it was. That was good. There you go. All right, so let's get into it. When it comes to superannuation, there are 3 pillars of the Australian retirement system. The first one is superannuation. The second one is the age pension, and of course that's means tested. The third one is private savings or investment, so when you're providing for your own retirement, if you like. They're the 3 pillars. So you really need to start to make some planning about which of those 3 pillars are you going to focus on. Is it all 3? Is it 1 or 2? Now, typically, most people would like to invest and save so that they're not relying on the age pension. Imagine trying to deal with the government when it comes to your finances. Too many questions, too many limitations. And so most people, the other 2 options are the preferred options, and that is superannuation and your private investment. Now, superannuation is still a little bit tinkered, with by the government, but there's still a lot of benefits, and it is your money, right? So it's something that we do want to focus on. I was reading, there's a couple of surveys that I found interesting. There was one, there was 2,000 people that were surveyed by the Association of Superannuation Funds. And they found that for the majority of those people, superannuation was near the bottom when it came to in terms of their activities or thoughts daily or anything about the future. So it was right down the bottom. And the other thing they found was there was about 65% of the people that found that it was just overcomplicated. It was complicated. I can't understand it. The government's messing with it. There's tax, there's this and there's that. So what we want to do today is be able to talk through some of those things and debunk some myths so that you have an understanding of the superannuation system here in Australia. So for our international friends, the superannuation system or the retirement system is going to be different in different countries. But here in Australia, we have a really good retirement system. So we're going to talk about that. And one of the other studies that I came across was the Super Members Council of Australia, and it was in the Australian Financial Review. And it said that 2/3 of retirees are drawing more money from their super funds than they're required to do. And up to 80% of men, 90% of women have none left when they reach their expectancy age. So if you think about that, our expectancy age for women tends to be around about 84 now, and that's slowly increasing. For men, it's 82, 83. So what that research has found, or that study has found, is that people are running out of money. They're running out of their super, they're running out of money. And because it's such a big part of the Australian retirement system, the government is wants to encourage people to contribute to superannuation so that it does last. But what we do know, and what most of the people were able to acknowledge, is that superannuation is important for a comfortable retirement. Unfortunately, there are a lot of people who just think, well, my super will provide for a retirement, and therefore don't invest or save external to that. There are others that do both. And there are others that just say, oh, well, I might have some super and I'll rely on the age pension, which we know the cost of living is increasing every year, and it's not the thing I think you would like, if you can avoid relying on the age pension, I think that is preferable, but it is there as a safety net for sure if you don't have, and you won't end up living out on the street. Okay, so when it comes to super, one of the things I thought that it would be valuable to you that if we talk through some things about superannuation that you may not know, okay? Because one of the things that we hear about is superannuation. Yeah, well, you can't access it. I've got to be old to get it. By then, I don't even know whether I'm going to be alive or what shape I'm going to be in. And so it tends to get pushed down, just like that study showed, it tends to get pushed down in terms of a priority. But I want you to imagine it like this. I want you to think about it as that if someone said to you, I'm going to be putting regular amounts of money in a bank account for you, okay? You can decide how you invest it, but I'm going to be putting regular amounts of money. Now, let's say, for example, you're on $100,000 a year. Then that person, because it's superannuation, that person is going to be putting in about $11,000 a year into that account for you. So someone else is putting money in an account for you. You're responsible for how that money is invested. There's only one catch, and the catch is you can't have access to it until a certain age. And the superannuation age is, preservation age as they call it, is 60. So if you think about it like that, I think you'll start to look differently at your superannuation, because that's exactly what's happening with your superannuation. You have your employer who's required to put, at the moment, it's 11% of your gross income has to go into superannuation. That amount is paid quarterly. There's a requirement to be paid quarterly. And so that's going into superannuation. That's your money, because then you decide how that money is invested. Now, what I've found over the years, and I'm still finding, is a lot of people are just sort of, it's there. They get a statement every year. They see that it goes up. Now, it's going up because there's contributions going in, but it's also going up because there are there are returns in the fund. But they just sort of, oh, well, it's there, it's growing, that's great, I'll leave it there one day. Particularly if you're in your 20s and your 30s, it's not just, oh, one day. But I just want to emphasize and highlight the fact that it is your money. Using that example of that bank account, if you think about it like that, I think you're going to start viewing it differently, right? Because just in that example, the difference is you just don't have access to it, but it's still your money. And so it is important to consider it. So one of the things that we need to know is superannuation is not an investment. You say, hang on, Ziggy, it's not an investment. I thought you just said it's going to be for retirement, I'm going to use it. That means it is an investment. Well, there are investments in superannuation, but superannuation itself is simply a tax structure. The same investments you can have within super, you can have outside of super. You can invest in Aussie shares, international shares. You can put it in cash. You can do the same thing within superannuation. So superannuation is a tax structure. I won't get too technical on you, but it is a trust. It's a trust structure, and it has tax advantages. What are those tax advantages? Well, the income that super fund earns pays a maximum tax of 15%. So if you think about your income tax rates and the different scale, the more you earn, the more you pay. In superannuation, it doesn't matter how much income the fund receives, it's taxed at a maximum of 15%. On top of that, there's a capital gains tax. So in our own personal names, if we had a capital gain, let's say we sold an investment property, that capital gain would be added onto our taxable income for that financial year, and we'd be taxed at our own marginal rate. Well, in superannuation, it's taxed at a maximum 10%. So it's a very tax-effective environment to be creating wealth and to grow wealth. So the sacrifice is, or the trade-off, if you like, is that, okay, well, I don't have access to it, but I'm getting some really tax benefits from an income and a capital gains tax perspective. And we'll talk about contributions in a second as well. You're not allowed to put as much, well, we're coming to contributions, you're not allowed to put as much money into super as you would like. So there are limitations. Okay, you can't just say, well, I'm going to put as much as I like. No, you can't do that. Most people will find that the caps or the limitations that are in place are more than adequate if you're wanting to, as a strategy, if you're wanting to put money into super. There's two types of contributions. There's what we call the concessional contributions, so the tax-deductible contributions. And then we have the non-concessional contributions, which are non-tax deductible. And of course, as the name suggests, when you make a contribution into a fund, you can claim it as a tax deduction. So when your employer makes that contribution, the employer claims it as a tax deduction. The cap in this financial year is $27,500. So if the employer is putting in that previous example, if you're on $100,000, if the employer is putting in $11,000, you've still got a balance to up to that $27,500 if you want to make additional contributions, and you can claim that as a tax deduction. which is really good because many, many, many years ago when I started in the industry back in 1990, the only people that were allowed to put money into super and claim as a tax deduction were people that were self-employed. Okay, but now it's available for anyone to claim it as tax deduction. So obviously, the closer you are retirement, the closer you are to having access to your money, it does make sense to be, really putting a lot, as much as possible as part of your strategy into superannuation because it is tax effective, it's in a great environment, and the younger you are, I think it's generally speaking a good idea just to be regularly putting an amount in. Doesn't have to be a lot because obviously the younger you are, you've got other commitments such as mortgages and family if you have rent, whatever the case may be, right? But there are caps. So there's caps when it comes to the deductible contribution and there's caps when it comes to the non-deductible. So the non-deductible, the non-concessional, you can put up to $110,000 a year. The third one that we're looking at is what is the tax in super. So I did mention the tax in super in terms of an income and the capital gains tax right now, but not only is it a very tax effective environment to be creating wealth until retirement, but the beauty is once you reach that retirement age, so that preservation age, once you've reached that preservation age and you've retired, then everything in the fund becomes tax-free. So there's no income tax, there's no capital gains tax. Any income that you draw out of super is tax-free to you. So it makes a lot of sense to be creating a big part of your wealth inside the superannuation system. Now, yes, the government does tinker with it from time to time, but they haven't made a lot of changes, not as many as probably you would think. Having been in the industry now for 30 years, I've seen some changes, but the major thing is that the government understands that they want people, as many people as possible, to provide for their own retirement, so they provide a lot of incentives for people to build up their superannuation, to contribute, and therefore at the other end to receive that tax-free. So when you receive that money as what we call a pension just means an income stream. When you receive that money as a pension, that money is then totally tax-free, right? So it's really good area to be creating wealth. And the thing is now is that preservation age for the majority of people is going to be age 60. Now, that doesn't mean that you're going to stop work. It just means that once you've reached that preservation age, if you do retire, you've got access to your superannuation. You've still got access to your superannuation at age 60, even if you don't retire, but you can only receive part of that super by way of an income stream or a pension, and that's called a transition to retirement pension. So that'll depend on, you're working, whether you need that extra money out of super, you can supplement any of your income that, from work. So it really is a strategy that's got to be appropriate for you. But generally, from the age 60, you've now got access to your superannuation money. And because we are living longer, we're getting to that, feels like we're getting to that age 60. I'm 53, but it feels like you're getting to that age 60 quicker and more people. And it does come around very quickly. So good place to have your money. Now, when can I access? We've spoken about that. There's a preservation age, and you can access your money either as a pension or as a lump sum. So as I said, a pension is just purely an income stream, and then as a lump sum, if you want, you can pull it all out. If you want to get the age pension and you're not eligible, well, pull out all your money super, go to the casino, put it on black or red. If you lose it, you get access to the age pension. If you win, you got more money, you won't ever need the age pension. No, that's not good advice. So accessing super over the age 60, and there's the two options. One other thing you may not know. So when it comes to superannuation funds, there are fees. Nothing comes for free. There are always fees, and there are other transactions or other debits that come out of your super fund that actually deplete the super fund. So you do need to be mindful. So when you get that annual statement, I would encourage you to be looking at the transactions. Look at the opening balance, right? Because they give you a summary. The opening balance, then contributions received from your employer, investment returns or losses, at fees that are coming out, and maybe insurance premiums that are coming out as well. Now, really look at that, because when it comes to the fees, there's a few different types of fees. Different superannuation funds charge differently. Some will have an admin fee. Some will have an admin fee plus the trustee fee. Some will have an admin fee and a member fee and a trustee fee. So you really need to be very careful when you're comparing. It's not just the admin fee that you see, because there are some fees in funds that you don't see because they're coming off the return. So, for example, instead of getting 8%, you're getting 7.5%, and then the admin fee is being deducted as a direct fee. Most superannuation funds, particularly the most retail and wholesale funds, will actually be very transparent and will show the actual return and then the actual fees. And to me, I think that gives you more transparency, so you can really assess, is this the best fund for me? Because we look at, when we're doing research and we're looking at funds, we are considering fees, which is not the be-all and end-all, but it is very important. So be careful of the fees of the fund, but also look at other deductions that are coming out of the fund, because more often than not, a lot of people have insurance in their funds. They might have life insurance, TPD, which is total and permanent disablement, and they may have income protection, right? And those premiums are coming out. You're paying for them. It's not the employer that's paying for them. They're coming out of your fund. Now, you need to review that, because maybe you don't need that insurance. Maybe once you look at it, you think, oh, gee, I don't have enough insurance. If something was to happen to me, my family's toast. Well, that's not a good situation either, and that'll be a discussion for another day. But just review things, and it doesn't take much. That study said that most people find it complicated. I mean, this is why we financial planners are around, to be able to give you some guidance around that. Get advice. It's worth paying and getting the advice. It'll save you loads in the long run. Trust me, because I've seen over the years multiple people that have come through, have got multiple superannuation funds because they haven't brought them all together. So they're paying fees in different areas. They've got insurances in different funds, and what it does is just depletes it. So for the cost of some advice from a financial planner, the long-term benefits are huge. Okay. Now we've got, when it comes to the tax deductibility of contributions, I mentioned before that up to that $27,500 you can claim as a tax deduction. Now, the thing is, the government have now allowed you, if for the last 5 years, so there's that cap, right? $27,500. That was for the last 2 years. Prior to that, the maximum was $25,000. If you haven't used that cap, then you're able to carry forward the part that wasn't used, or that hasn't been used, and that's called a carry forward concessional contribution. You can get that information from your MyGov, or your accountant can give you that information. What that means is that you can actually put in more than the current year cap, because you've got this carry forward cap that you haven't used. So if you've got cash sitting around, you don't really need it, what a better way to build up your wealth through super by using that concessional contribution, that carry forward balance, and putting that money into super, very tax effective environment, and also you're getting a tax deduction on the way in. Okay, it's a really good strategy. Now, you're getting a tax deduction on the way in, but remember the super fund is paying tax in the fund, because that contribution is income to the fund and it gets taxed at 15%. But even if you're at a minimum of 30% tax, or even if you're the high rate of 48%, overall, it's better to pay 15% than it is to pay 48%. All right, superannuation is more than retirement. What do we mean by that? Well, when it comes to superannuation, as I said, it's not just about the fees. Fees are very important. The other thing is you want to look at, where is the money invested? Because you have direct control as to where that money is invested. You can have it sitting in cash. You can have it sitting all in Australian shares. You can have it sitting all in property. You can have it sitting all in international shares. So if you want international exposure and you want access to and be investing in, Apples, the Microsofts, the Amazons, all these big companies in Europe, great parts of Asia, then it's good to have some access to these international funds, right? Because that gives you access to quality companies that are so much larger than companies, in Australia. The Australian market represents about 3% of the global market. So it would make sense to diversify, spread your risk, and invest in these areas as well. And so a lot of funds will provide what's called a model portfolio, which is based on your risk profile. So, for example, if you think you're conservative, then there's a model that's been set up for you, and it's called the conservative, profile or model choice, option. If you're high growth, so if you're aggressive and you're a growth investor, there's an option there for you, and they manage all of that. They select the funds then select who they're investing in. So it's a model portfolio, and it's all done for you. If you're an average investor, or what we call a balanced investor, which is about 50-50, again, there are model portfolios. Now, there are other options, depending on the amount of money that you have in super. There are other options, such as what we call a tailored portfolio, which just means that you can be selective, using a financial planner to get advice, be selective in the funds that you invest in. What that means is that you've then got more transparency. You can look at those specific funds and actually see who they're investing in. You can see their specific returns, and you can make changes as you go as well. So using research, the research tells us, gives a rating on these particular funds and say, are these funds doing what they said they were going to do? And so they're reviewed every quarter, and if there's that rating change, then we can be nimble enough in the portfolio to be able to make a change. Let's say the rating drops, because they usually use star ratings up to 5. Let's say that rating for some reason drops from 4, it goes from 4 to 3. We look at that, look at the reason, and then we may say, look, we're going to replace that fund now with another one that's a 4 or 5 star rating. So that gives you the flexibility in being nimble enough that you make that change. And long term, that means you've got a really good tailored portfolio that's active, got a good range of different fund managers that are investing all over the world. They're specialists in their field, specialists in North America, specialists in Europe, specialists in Australia, and they're working as hard as what you're working, right? Now, the aim is that if you've got a larger amount of money in superannuation, so let's say even if you've got, a couple $100,000, and you're able to extract another 2 or 3% on average, as opposed to just that model portfolio, which still does well, nothing wrong with them, right? But that makes it worthwhile in doing so, because the tailored portfolios, from a fee perspective, are a little bit more expensive, okay? But on 200,000, if you're extracting another 2 or 3%, that's $4,000 to $6,000 a year. So even if it's costing you $1,000 extra a year in fees because of this tailored portfolio, that makes it worthwhile. On a portfolio of 20, 30, 40,000, it's neither here nor there. It's still early days. Maybe the model portfolios are going to be appropriate, for you. But remember, this is not personal advice, because I don't know your personal situation. We're talking about general facts here and talking about the different options in superannuation. So you have total control as to where that money is invested. So when you're getting that annual statement, have a look at where your money is invested. It's funny, because when I do ask people, so your superannuation, where is it invested? Oh, don't know. There are other people who know where it's invested. Oh, no, I'm in the high growth fund. It's usually people that are in the high growth that are a bit more active with their finances, right? And will invest for high growth, which over the long term gives you a greater return. But there are still a lot of people that don't know where that money's invested. A few weeks ago, there was a client that came in, had a substantial amount of money and in super, and the majority of it was sitting in cash, and it's been sitting in cash for the last 12 months, right? Not a good place for superannuation to be sitting for a long period of time. Different if it's for a short term. But even then, one of the things we'll talk about on another episode is the timing of the market. Some people actually say, I think the market's going to drop, and therefore I'm just going to move into cash and sit tight and wait. That's a no-no in my view, because no one knows the timing of things. Anyway, that's for another episode. But you need to know where your money's invested, because again, as I said, it's your money. So that's superannuation. I hope I've been able to bust some myths, or we've covered a few things there. But the questions, the regular questions that I get about superannuation, and regular comments, right? This is one of the myths I want to bust, is that the fund managers, they're just all about fees, and they don't look after you, and they don't get you any returns, and therefore, mate, I'm just setting up a self-managed super fund. That's what I'm going to do. Oh, I start to cringe when I hear that, because There's the fund managers. Yes, of course they do charge fees. You and I wouldn't do what we're doing if we didn't get paid. That's why there's research. There's why analysis that can be done to make sure they get the returns for you. But just to just sort of, throw out a generic comment that says, they're no good, I'm going to set up my self-managed super funds. If you think you're better than the experts in the area, fine. I'm not. But anyway, there you go. So that's superannuation. I hope you've enjoyed it. I hope we've given you value. I hope that you've been able to get some level of understanding because, again, this is your money, this is your future, and so you need to be planning when it comes to superannuation. And like we say, you need to plan to prosper because when you plan to prosper, everyone wins. Cheers.